If you can't perform two of your daily living activities like bathing, dressing, eating, toileting, transferring in and out of chairs and beds, and managing incontinence, you might need long-term care. First, what is long-term care, who needs it, and how early should you buy it? You can think of it as protecting your financial assets from the wildfire effect of having to pay for someone else to care for you if you become unable to care for yourself. Being hit with unexpected and exorbitant bills for a nursing home stay or in-home care can wreck a great retirement plan if you didn't prepare. See, most people will need some type of long-term care at some point. The average duration for long-term care is 3.7 years for women and 2.2 years for men. Long-term care pays for a specific amount of type of medical expense for you or a loved one. Buying long-term care insurance is paying now to soften the financial blow of a larger cost in the future. The best time is usually in your late 50s or early 60s, but you want to shop for it while you still have good cash flow and you're still young and healthy enough to get a good rate. Long-term care provides nursing home care, home health care, and personal or adult daycare for individuals age 65 or older. It's a matter of finding a balance between purchasing while you're young and healthy to keep the premiums lower, but not paying unnecessary premiums at too young of an age. If you've had a personal experience in caring for a loved one, or if cognitive disease runs in your family like dementia, you should strongly consider it. If it's important for you to leave a financial legacy and you're concerned that you might burn through your nest egg just to pay for long-term care expenses, you should definitely consider it. And taxes are important. If your main asset is a tax-deferred 401k or an IRA, it will be quite costly to spend down your assets to pay for care because your taxes needs to be considered. See, long-term care insurance will reimburse you tax-free to avoid drawing down other assets. The average cost of a nursing home is north of $100,000 a year or just about $8,000 a month. A policy that fully reimburses you for this amount will cost a pretty penny. Nowadays, carriers actually offer traditional long-term care and hybrid options. Hybrid options offers you more flexibility, more bang for your buck, and often fixed guaranteed premiums compared to traditional long-term care insurance that aren't guaranteed and they fluctuate over time. With a hybrid option, the carrier offers you a death benefit, access to investment strategy with sub-accounts, and a pool of long-term care coverage. Policyholder doesn't need the long-term care insurance, they have the death benefit and access to the accumulated assets in the sub-account. Do a 1035 exchange of a cash value of life or annuity. If you build up cash value in a permanent, not term life insurance policy, and you may no longer need the coverage in retirement, you can do a tax-free exchange of the cash value into a long-term care insurance policy. See, the same can be done with annuities, amplifying the annuities tax benefits, where traditionally annuity contracts are taxed on earnings. With a 1035 exchange, it becomes tax-free. If you can afford to self-insure, but you want to leave a financial legacy, you can buy a permanent life insurance policy to replenish the assets when you die. Even if you had to pay for long-term care near the end of your life, this financial legacy could protect your surviving spouse's financial independence or guarantee a financial legacy for your children. See, many self-insured retirees also want to avoid burning through their entire nest egg if they need care. The cash value in a permanent life insurance policy can also act as a source of emergency funds in retirement. For more information, book a call.